Hello, I'm Vadini Arya. This video is about how do we measure financial health in a business using ratios. What is a financial ratio? Financial ratios are quantitative metrics that assess a company's or organization's economic health and performance. They give valuable insights into a company's financial situation, helping investors, analysts, and management makes informed decisions. Financial ratios are powerful tools that give valuable insights into a company's financial standing, allowing stakeholders to make informed decisions and strategies. Understanding financial ratios. This complete commentary will explore the impression of financial ratios and their significance in assessing financial health. What is the importance of financial ratios in business? Financial ratios assist you in making sense of the numbers given in a financial statements and are powerful tools for deciding the full financial strength of your industry. Ratios consist of various classes and contain profitability, liquidity, solvency, efficiency, and valuation. How do you explain financial ratios? Explaining financial ratios involves analyzing the calculated ratios to achieve insights into a company's financial health, performance, and operational efficiency. Financial ratios should be presented in the context of the company's specific industry, competitors, and historical performance. Determining a company's financial health is a vital business skill. If you own your industry, you must know your company's performance for many reasons. Having a healthy explanatory photo of financial health can help you make better decisions about your organization's direction and allocation of resources. Similarly, you must assess your business's financial health to attract investors or seek financing. If you are a manager, you must understand your organization's financial health to direct your team better. Without that understanding, pursuing projects with no exactly stated return on investment or initiatives that don't contribute to your company's well-being can be easy. Knowing a company's monetary health can also benefit you as a worker. Recognizing when your boss is doing well might be a good time for you to ask for an increase or promotion. When you know that your employer is facing problems, you can take steps to either exhibit your worth or look for another job in another organization. While there are many metrics you can use to estimate financial health, one of the surest is financial statement analysis. Here is a look at the different analysis you can conduct to understand your company's financial health better. How do we verify the monetary well-being of a business? Analyze the balance sheet. The balance sheet is a report that declares a company's financial position at a specific time. It gives a snapshot of its assets, liabilities, and owner's equity. The company runs the business using its assets. Liabilities are the debt that the company owes when it borrowed from other sources and must pay it back. Owner's equity in a limited or private company means owners have provided financing for the business. It is important to note that assets should always be the total of liabilities and owner's equity. This connection is the basis of the accounting equation. Assets equals liabilities plus owner's equity. The balance sheet expects assets and liabilities to be displayed as current or non-current, indicating whether they are short or long-term. Short-term investments are those anticipated to make cash within a year. There is no anticipation of long-term conversion within a year. Similarly, short-term liabilities must be paid back within a year. Long-term liabilities are not payable within a year. The balance sheet gives the facts and reports on a company's financial well-being by assisting you in investigating the result. How much debt the company has in equity. How fluid the business is in the short term, less within a year. What percentage of assets are typical and what proportion comes from financial dealings? How long does it take to get unpaid costs from consumers and backsellers? How long it takes to sell stocks the business is left on hand. Analyze the income statement. The income statement declares the company's financial position and performance by examining income, expenditures, and profits achieved. You can create one for any period using a trial balance or transactions from any point. The income statement usually begins with the income made for a period less the production expenses for goods sold to arrive at the gross profit. Then all the other expenses like admin, wages, field cost like heat and lighting, rent, and expenses such as depreciation to decide the income before interest and tax. Finally, to calculate the net profit, interest and tax are deducted, which will be the owner's profit from the business. This money can be paid dividends or reinvested into the industry. The income report gives reports on a company's financial well-being by helping you analyze the following. How much revenue is growing over specific accounting dates? The gross profit margin for the income from sales. What proportion of income results in a net profit after the entire expenditure? If the business can make its best debt interest repayments. How much the company repays to shareholders versus how much it reinvests. Analyze cash flow statement. Cash flow statement is a document and a roadmap guiding us through a company's financial journey. It describes how a company employs cash during its accounting period. It shows the traces of cash flow and various areas where money was spent, grouped into processes, investing, and financing performances. It's a crucial tool for understanding a company's financial health and should be a priority for managers, owners, and investors. The cash flow statement is one of the most essential papers used to examine companies' finances, presenting acute perceptions of the cohort and use of cash. The income report and balance sheet are built on accumulation accounting, which only sometimes matches the actual cash developments of the business. That is why the cash flow statement exists. To delete non-cash operations effects and give managers, owners, and investors a more transparent financial snapshot. The cash flow investment statement gives reports on a company's financial well-being by helping you examine the following. The liquidity condition of the company. The company's sources of cash. The free cash flow the company creates to advance investment in assets or operations. Further, overall cash has increased or decreased. Financial ratio analysis. Financial ratios help you comprehend the numbers in financial reports and are compelling tools for determining your company's financial health. Ratios fall into several classifications: profitability, liquidity, solvency, efficiency, and valuation. Some of the financial ratios you must know are gross profit margin, the proportion of profit the company creates after the direct cost of sales charges has been subtracted from the income. Net profit margin, the proportion of profit the company creates after all costs have been removed from the revenue, containing interest and tax from revenue. Coverage ratio, the company's capability to meet its financial commitments, cover its debts, and join interest payments. Current ratio, the company's capability to meet short-term debts within a year. Quick ratio, the company's capability to meet short-term debts or of less than 1 year using only highly fluid assets. Debt to equity ratio, the proportion of obligations versus equity that the business uses to invest itself. Inventory turnover, how many times did the inventory sales happen? Total asset turnover, how professionally the company creates income from all its assets. Return on equity, the company can use equity assets to make profit. Return on assets, the company's capability to control and use its assets to earn profit. Financial ratios should be contrasted through periods and in contradiction of participants to see whether your company is developing or failing and how it's promoting against direct and secondary competitors. Each ratio or statement is needed to examine the total financial health of your organization instead of grouping of ratio. Examinations throughout all statements must be used. I hope you like this video and also find it useful if you are running a business. Thank you very much for watching my video. Thank you. Bye for now.